I saw this email and I said, oh my God, that's right.
How they changed it from where they. All right, so there's Ken in the waiting room. There he is. All right, so if you give me the mouse, I'll let James in if he comes. And then it does show in the top. It did a minute ago. The pause button.
It has moved down here, but I don't see it down there. Oh, here we go.
There you go.
Okay, so let's call the meeting to order. And I think the first thing we want to do is approve the minutes of the last meeting. So
Do you want to do on your agenda? You have pledge and then public input.
Oh, okay. Should we do the pledge then?
Sure.
Okay. Right there.
Keep to the agenda.
Okay. All right.
Pledge of
allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all.
Okay.
And then you have public input next. And then you can
Okay.
get
Public
into
input.
minutes.
No public input.
The treasurer's just sitting here.
The treasurer has no public input. Saw you vote yesterday, though.
That was his public input.
Yeah, that was a public input. Okay, so what we'll do is we'll go and review the minutes of the last meeting. Has everyone had a chance to look at the minutes from the last meeting? Is there any objection to it or anything to add or subtract?
I move to approve.
I'll second that.
Second that. Okay, all in favor? Aye.
Aye.
Okay, minutes approved as presented. And the next thing on our agenda is really the review of the financial results here, the town budget, the town and the LoSAP plan and the police plan. So Mike, why don't you start?
Yep. So for the second time in my 25-year career, and I'll do a little explaining. I mentioned the Bloomberg Global Ag for Russia, which is the fixed income benchmark for Russia being down 98.9% in the first quarter. There's also the Bloomberg, US Ag. So what is the Ag? The Ag is sort of the benchmark of fixed income, right? So how did bonds, muni bonds, government bonds, agency bonds, corporate bonds, how did bonds do in the first quarter of the year? Negative 6.6%. And really the effect, the downward pressure on bonds can be summed up with three important realities. The first reality is inflation. And, we're seeing inflation. You guys are, I'm sure, picking up on the numbers. You probably heard that word more in the last 3 months than you have in your entire life. Maybe not some of the people that were around in the 70s, but the inflationary numbers continue to pile up. Obviously, the war in Russia is not helping that number. And the Fed has a pretty proven, powerful tool to head off inflation, and that's interest rates. And they are signaling, and you hear, some of them are more hawkish and some of them are somewhat dovish, but the overall consensus is that, significant rate hikes are coming. They're now talking 50 basis points instead of 25. Yesterday, for the first time, I heard the 75 basis point hike, which happened in 94. Ed reminded me it also happened in 81. So it's not unusual. If you think about, if you go buy a TV at Best Buy right now, right, you get 0% interest. Well, the mortgages and, over 5% now on the 30-year fixed, and, what it will do a good job in slowing down the economy. slowing that and potentially cutting off inflation. So inflation is not good for bonds, right? If you earn 3 and inflation 7, you don't have to be a mathematician to realize what's going to happen there. Rate hikes, is it going to be 6? Is it going to be 7? Are they going to follow through? So we know that significant rate hikes are coming this year. They're talking about getting to what they feel is normalization, which people debate what normalization is, but is normalization 3.5? Is it 4? Is it 4.5? So if they get to 3.5 by the end of the year, it doesn't take a mathematician, 6 hikes, to get there. You're pumping up rates greater than 25 basis points, at least on 2 occasions, but you're consistently raising hikes. So remember, bonds are no different than a CD, and that there's a beginning, a middle, and an end. And in the end, you get return of principal. So when you have drops in bond prices, although it's not fun to go through for anyone, just know that the positions that we hold in the pension plan are institutional. In other words, we actually have the bonds. And you might remember that we have, and we'll get into the actual strategy later, but rest assured, we're not, the town of Bethel is not going to lose 1 penny in our fixed income portfolio, because we're going to hold the fixed income to maturity and get return of principal. And at that point, right, you've heard me talk about it in other meetings, we are ultra short. Mm-hmm. And we have, in just the town pension plan alone, 15.8 million in bonds that are maturing in the next 24 months. Most of them are maturing in the next, 14 months. So when they mature, we'll be able to participate in the new rate environment. The last thing, and it's significant, and it's kind of disappeared from the headline of the news, but you remember QE1 and QE2 and QE 900 and QE 5 million. Well, in COVID, the Federal Reserve has bought $6 trillion of treasuries and mortgage agency bonds. And they have a monthly bond buying program, which has already started to the word taper. Taper simply means they went from buying 120 billion to 100 billion to 80 billion. And so above and beyond the inflationary backdrop, above and beyond the rate hikes that are coming, we also have the Federal Reserve not buying fixed income. And so these bonds are rolling off. And the bond market is about to stand on its own 2 feet for the first time in a long time. So with the bond prices dropping, it's actually a good time to be putting new money into fixed income, right? If par's 100 and 6 months ago you were paying 110 for a bond, and now they're at 98, you're going to get back 100, right? So the other risk in bonds, by the way, is default. Okay, so the fixed income that we currently own in the pension plans is the U.S. Treasury. The U.S. Treasury is known as the. Someone saying something?
Ben, do you have a question?
No.
U.S. Treasury is the safest, most liquid asset in the world. The reason why China, the reason why other countries own it is because they want to support our system. The reason why they own it is because it's the safest, most liquid asset in the world. And so the demand for fixed income is there, right? With retirees, with pension plans, with insurance companies, with banks, insurance companies and banks. How many fixed income products, long-term care, life insurance, a lot of these insurance products are built on the chassis of rates. And 10 years ago, did these insurance companies think we'd be at zero? So they're, coming off of 5 years in zero rates, did they see another decade of zero rates? And the answer is absolutely not. So as bond prices fall, there's plenty of buyers that are going to step in, but it's going to be disruptive to say the least. So the background of the first quarter was certainly a challenge as COVID started to wind down and the reopening began, and that and I say reopening began and COVID sort of started to end. Well, that's in the United States, right? You go to emerging market countries and you see what's going on in Shanghai right now. I mean, Shanghai's still in lockdown. And so although we are reopening and the shift from goods and services to from goods to services has begun, you know, outside of the United States, it's a little different. The economic outlook from Morgan Stanley for the next 10 years in capital markets is not very optimistic. And I also read Blackrock's outlook and Vanguard's outlook, and they're eerily similar, and that the outlook for stocks in the United States is pretty ho-hum, and that the 10-year return within the S&P, within growth in particular, isn't great. But the other thing is that all three of them think that the bigger returns are going to come outside of the United States. The war in Russia could change all that, but we're still kind of figuring that out. The S&P trades 18 times forward earnings. You know, you go outside of the United States and you're looking at 6, 7, 8 times earnings. So from a valuation perspective, it's hard to argue that there's less expensive stocks outside of the United States. That's kind of the backdrop as we go into what we're going to do is go through the town, the largest of the three plans, and then we can kind of end there because all three plans have the exact same asset allocation. So you're going to see the same numbers. And so let's get into it. You know, the size of the town plan now is a little over 38 million. We do pay out about 180, we pay out 185,000 in monthly benefits on the town plan. The town plan is different in the police plan demographically, and that we on the town plan, you might remember this from Milliman or the actuary, the town plan pays out more than it takes in. That's normal, and that trend will continue as the retiree population grows, the working population shrinks, and that trend is going to continue. You know, it's important for us to work with Brad and to make sure that we're on top of the liquidity to meet that monthly requirement. On the next page, you see our overall asset allocation, and you can see 10% alternative, cash, and this is a snapshot in time, right? This is the March 31st valuation. We do have an investment policy statement that you guys are all, I'm sure, aware of, and that as each of the buckets shrink and grow, is that on a monthly basis, the reallocation is being done. Your asset allocation, you know, being, let's call it 60% equities, of which 10 are alternative. Alternative is a big word, right? Alternative investments, hedge funds, private equity, private credit, real estate, MLPs, gold. So alternative is a big word. We have substantial footprints in 2 alternative asset classes, real estate and MLP. The best performing sector of the portfolio has been alternatives, and we've seen 40% growth in energy and energy stocks this quarter. Keep in mind that the energy and the energy related stocks only represent 3% of the S&P 500, and there's a massive trend to ESG investing. And the amount of new money going into that sector before the war has really dried up, and the trend, so oil being up 40%, it's still significantly under-owned. And by the way, the alternative that we own is the MLP. So that's the energy infrastructure. So from an ESG perspective, you know, the town isn't investing in stuff that's going to kill the planet. You know, the pipeline is the infrastructure that allows energy to be stored, to be transferred, whether that be fossil fuels or electric. They need the infrastructure, and it would go through those same types of investments. And the other is Reits, real estate. And how many people do you know in your life that were so negative on real estate in the lockdown of COVID, right? It was going to be the death of office buildings and retail, and boy, has the opposite of that just occurred. So our overall asset allocation remains the same. I don't see us, you know, we took the alternative position about 2.5 years ago. I don't have any recommendations to changing the overall asset allocation to this date. Moving on to our equity allocation, we are 65% domestic within the United States. By the way, we have the institutional managers, so we have all of the different asset classes within that. So we have large cap growth, large cap value, mid cap growth and value, small cap growth and value. You know, it has been a large cap growth market that has shifted to a large cap value market. Small cap has not done well in the first quarter of this year. Small cap did very well during COVID. So it's really impossible to time, I think, capitalization rates and to particularly within a pension plan with a, you know, with a 30+ year life. And keep in mind that the reason why pension plans typically do better is that commissions and investment committees, you know, people have a sort of an easier time thinking long-term with these types of accounts than they do their own money. And so that, you know, small cap, yes, it's out of favor. The time when I'm here in 3 months, it may be the best performing asset class. So, I mean, that's how quickly that flips. So our position in the equity, 65% domestic, I'm very comfortable with where we are. You do see that we are using ETFs. We have some passive investments, and then we have active where the town actually owns the stocks. So you can see the top positions by sector. Not surprised you have an Amazon or Microsoft, you know, being the top two after the ETFs, just because of the explosive performance within those. I mean, the cost basis of those two stocks for the town is, you know, significantly lower. And you can also see within the portfolios, those are being trimmed, both from our investment policy statement and from, you know, the mantra of the managers. I mean, if Amazon starts at a 3% position of the large cap growth portfolio and goes to 6%, by perspective, it's required to be sold off and lightened up. So stocks are important to own for the very reason that bonds are having a tough quarter. Stocks are a hedge against inflation. How do we beat inflation? You got to own stocks. You got to own risk assets. And over long periods of time, stocks are a proven way to outpace inflation. The most recent inflationary data, you know, 7 and 9. You know, is it realistic for the S&P in the next 10 years to do what it did the last 10, 18? I would say no way. You know, is it realistic for the S&P in the next 10 years to do 7 and 9? Possibly. Morgan Stanley's prediction, Vanguard's prediction, Blackrock's position for domestic stocks is more like 3 to 5 in the next 10 years. Internationally, 7 to 9. So, do we go out and put it all international? Heck, no. I mean, there's obvious political, governmental reasons and FX reasons of why I think I'm comfortable with the international exposure that we have. So that's a summary of our equities. On the back page is our fixed income. And what we own are US Treasuries, safe, liquid, short. They're down year to date. I'll get into exactly what they're down year to date. You might remember me in the time is now to start moving out in duration. Okay, not credit quality, not structure, but now you can go out in duration to 5 years and pick up investment grade corporate bonds with coupons of greater than 5% and pay less than par. We haven't seen that in 15 years, right? If you were buying an investment grade corporate this time last year, you're paying 117 for a 5% coupon, which meant your yield to maturity was below 1%. People were buying them, but we don't have any sweeping change in allocation. But the time is we're going to get paid to be short, and you'll see the manager start to buy some 3 to 5 year corporate rated securities because there's value there all of a sudden. At the same time, as the short term assets mature, we're going to get paid there as well. So I don't anticipate a loss in our fixed income position for the year or for the actuarial year. I'd be shocked. So think about it. The ag bonds down, let's call it 7%, 7% in a quarter. We're not going to be sitting here next quarter down 14. I think that the inflation, the rate hikes, and the QE, maybe not necessarily the QE, but I think those first two realities are already priced into the bond market. And that the worst is most likely behind us, and you'll start to see bond values start to come up, particularly, as the equity market continues to be on shaky ground because of the war. You think about it, World War III and nuclear, is on the table. I mean, the fact that is something that we have to lay our heads on our pillows at night and, think about, it's going to have a constant, pain felt in capital markets, particularly on the equity side. So that's our fixed income position as it exists. Now we move on to our alternative investments. And there you can see the Alarian MLP. That's the 35 biggest MLPs owned passively. MLPs, much like real estate or REITs, all of the earnings is passed on to the shareholder or it avoids double taxation. So the yield pickup on these things is, 5.5%, 6%. And boy, you will soon see that having a 10% position in alternatives has paid dividends. I don't think we need to go out rushing and buying more of this. I'm comfortable with our 10% position, which again does get trimmed on a monthly basis. When it goes to 12, when it goes to 13, we're selling. And all of the asset allocations in accordance to the investment policy statement. Another thing that's going on here that I don't think we've really talked about much in prior meeting is we have an independent third party called Clearwater Analytics. Morgan Stanley pays for that service. So there's an outside resource watching the IPS and relating it to the portfolio. So there is a lot of eyes on the rebalancing of the portfolios. Turning the page, here's the rubber kind of hits the road in the next 2 pages. Year to date, the pensions are down 3.5%. Right, no one likes to be negative, but Ed and I were on this commission, you know, for the last 20 years, and you know, these meetings were in the 08, 09 timeframe when it was like the end of the world was coming, and that, you know, there's a lot of bad things going on right now out there, and you know, the reality is, you know, we're down 3.5%. And
Actually, if I could interject,
Yep.
that's pretty good. I mean, right now, the Dow is down about 5%. The S&P is down about 60.7, and the NASDAQ's down about 16.5.
Yeah.
Okay, so being down 3.52, actually, you're beating the market.
yeah, so I mean, is there a town or a state or a wealthy family sitting around looking at their first quarter report with a smile like a check? The answer is no. And that, you know, who's up, right? I mean, and let's go to the next page. We'll talk about who's up. So all our alternative investments in the first quarter was up 5.89%. Great, but what's mind-blowing for someone who's been doing this for 25 years, that an ultra short, ultra safe US Treasury portfolio in times of crisis, there's usually a flock to the Treasury, the safest, most liquid asset in the world, right? People are selling risk assets and barreling into safe assets. What's mind-blowing is that, you know, a portfolio of Treasuries that are, you know, a 9-month average duration is -2.7. I mean, I had to read this over and over and over again to believe that it's true. And then I can see the positions. And if you ever wanted me to bring the positions, I mean, I don't, because you guys would all have packets this big. When you saw the you know, actual, everything that you actually own. I mean, does it make sense to you that a Treasury, you know, with a coupon that you're going to get par value at in 3 months is trading below par? It doesn't to me. For someone who's been doing this for 25 years in the business, that's the piece that I think is about to end. I think you're going to see these things snap back pretty quickly. So sometimes stocks carry the ball, like 2021 being up 20%, you know, and sometimes the fixed income or the alts carry the ball. But through diversification and time and prudent management, prudent asset allocation, holding the individual managers accountable on a performance standpoint, you know, firing them when they underperform, you know, is it reasonable for the town to hit its benchmark over the next 20 years? And you know, that benchmark has changed a lot, Ed, since in the last 20 years. And the answer is yes. I mean, there's no crisis, Bethel pension plans, and there's no, you know, we I think through this type of responsible management and funding, that you know, that the town funded ratios just over a long period of time will continue to get better. So that's it. I'll open up for questions if there are any, and just note, trust that the next 2 reports are just the same thing. One for the police, one for the LoSAP. The one difference on the LoSAP, because of the size of the account, it's not institutional, where it's mutual fund, it's institutional, but it's funds and ETFs, and it's not, you know, there you don't own the bonds, you don't, because the total account is $700,000. So it's just not, it doesn't have the scale to be at the same level.
Yeah, I can say that 3.52% down is roughly the same for the other 2.
Yep.
I mean, they're all pretty much about the same. And the alternatives have helped. If we didn't have the alternatives, we'd be down a couple % more.
Yep.
We'd be down closer to that 6%. So the alternatives certainly show in a diversified portfolio why you want to stay diversified when markets are in turmoil like they are now. And frankly, we're doing pretty well. I mean, it's hard to project between now and the end of the year how it's gonna look. But even if we end up, say, down 3%, after we came off a year last year of 12.5, if you average the two, you're still okay. So that's one way to look at it too. You're bound to have every 10 years a negative year. You're just bound to have it no matter what you do.
Yeah, I mean, there's over a decade, you'll have 3 to 5 negative years. And you know, it's a point in time. Like the end of the quarter is a point in time. June is a point in time.
It's a more important point in time.
If I were to project to the end of the year, I would say the alternatives would probably be a plus. The bonds will probably be a plus because of the way we're going to be taking the short terms that we have now and converting them over and getting better yields and all, and being able to pick up money on them. I mean, we're in a sweet spot right now. The higher interest rates go the quicker, the better off we are, actually.
The wild card is the war. And
yep.
You know, what I tell clients is that, listen, we can act like World War III, nuclear war, we're all going to die, or we can invest like this will end. And so once you accept that, you know, the wild card is this damn war, and when what, how long, and who, and but boy, if you know, if it ends in 10, 20, 30 days, you can imagine the reaction in capital markets would be overwhelmingly positive.
But let's say it drags on to the end of the year, then you may get results like this. So, yeah, it is a wild card. It's a black swan event. So, but I think, you know, the best thing we can do here is we've got good asset allocations. Everything is fine. We know we're going to be getting upsets in the market, but we're well positioned to take advantage of some of that. So we just keep it the way it is.
I'll tell you, I agree. You know, this is keep calm and carry on, right? There's no reason to hit the panic button. I want to go back maybe about 10 or 15 minutes, and this is a very naive question, but it was relative to the town. You said that the payout is more than what's coming in. So that tells me that that's not a sustainable model, but why should I not be worried about that?
We gotta
Ken, it's because we got rid of pensions for new hires.
Okay.
So you're getting I think when Michelle was in last, I think we ended 2021 fiscal year to like 95 actives. And I know at least 6-7 people have retired since then. Bob's retired since then. So your payouts are going up, but we don't have the actives refilling them.
Okay, great.
Yeah.
So it's a good thing. The plan is aging out, but that's the reason. And the police is stable because anytime somebody retires, they backfill with somebody that's paying in towards the plan.
Right.
So another way to look at it, Ken, is the goal on the town side is this account will be empty. It will be zero when the last, retiree passes away.
Gotcha. I told you it was a naive question.
No, it's a good question.
Okay.
No, I mean, you go out 20 years or 30 years, and hopefully the plan will be gone by then. And the 401k, 403bs that they're having now and the town's participating in will be the keep planning retirement.
Ed, I hope to still be alive.
Well, I'm going out 20, 30 years. Yeah, you could be.
I'll take that. I'll point up to 20 right now.
But maybe I go out 50 years. Take care of the young ones.
But yeah, the other thing too is our actuarially we can go out 30 years because we've been really good about making our ADC. We're down to like 13 years left on it. Michelle, who knows way more about this stuff, says you don't really ever want to drop below 10. So we'll have to rebalance it at some point, but because we've had good returns the last couple of years, we haven't had to. And obviously, if you go back out, I don't want to go back out towards 30, but it's going to drop your ADC, what you need to contribute. I'd rather the town still make the full contributions
for a while.
Yeah, and let's just bring our funded ratio up and up.
Right.
which are both very healthy plans, right?
Yeah, where's the funding ratio right now in the town? Is it
The
70%?
town's high 80s, I think, and the
Is it
police
that
are in the
high?
70s. Yeah.
Yeah, that's pretty good when you look at the across Connecticut.
Yeah, it's, if you look at it compared to the state of Connecticut, it's amazing.
Oh, yeah, well, the state's got problems.
Yeah.
No,
So,
but we're in good shape though financially, we really are. And I agree, keeping the funding at good levels is, I think, important, particularly now, you know, to keep it going. Maybe 10 years from now or 15, you cut back, but not right now.
yeah, and we've been smart. We have dropped the assumed rate of return the last couple of years.
Yeah.
Michelle, who's an actuary, so they like to play it super safe, which I get, says we're still high. I don't think we're that high anymore.
We're
Not in a high
Based on
relative to
what our
everyone else.
mid-sixes right now.
Yeah, I thought 6.5.
I think it is 6.5 now, because it was 6.65.
Well, we were over 7.
Yeah, I think it was 7.5 at one point. So this committee has dropped it down slowly, because if you made a big drop in it, your
No,
actuary contribution goes way up in 1 year,
exactly.
which we've avoided. So, no, I think we've done all the smart things. So,
Then we'd be asking the town for more money.
yeah. But even this last year, we did drop it. If we hadn't, the ADC contribution would have dropped in the budget, and because we dropped it a little bit, it actually went up a little bit year over year. So budget wise, yes, our budget number went up a little bit, but it was the prudent thing to do.
Exactly.
So, and it was a good time to do it because we had a great rate of return last year.
Yeah, the way to look at this again is long term. If we can make that 6.5% average or better over the long term, we're fine. We don't have to do it every year. There are some years you'll double it like we did last year, and there are some years you'll miss it. Are there any other comments or any other input? Hey, Mike, I think we're accepting everything as presented. And that's all I have. That's all that's on the agenda. So I think it's time to call for an adjournment. Do I have a vote on that?
Motion to adjourn.
I second.
All in favor?
Aye.
Aye.
Put on the sunscreen, Ken.
Okay, thanks, guys.